Great. Good morning, everybody. And bear with me while I figure this out. Give me one sec. Awesome. So if we're ready to get started, I'll dive right into it. So the name of the presentation is Real Estate Investing for Realtors, but obviously this isn't just for realtors. I just thought that it was really interesting that as I've gotten to know a lot of realtors, I found that a lot of them actually do not invest in real estate, which I found to be really ironic because they're the ones with the ear to the ground. They're working with a lot of homeowners and sellers and stuff like that, and they're seeing things sometimes before they even come on market. But I just found that really kind of crazy that they aren't investing in real estate at the same time. So I thought it was a really timely, important presentation to make. So some of the things that I'm going to talk about today, so just understanding some of the different types of real estate investments that are available. I think one thing that I was really surprised by when I started learning about more about real estate was just the sheer breadth of opportunities and things that you could. It's not just as simple as buying a property and being a landlord. I think especially for people here in Ontario, that can be discouraging when you think about the LTB laws and, just the cost of real estate and stuff like that. But there's so much more out there. So we'll dive into some of that. In addition, I'm going to outline some of the things like how to weigh risks versus rewards. And obviously, I think a big thing right now is trying to protect your hard-earned money. I think there's been a lot of chaos happening in the industry in the last 6 months that I'll, touch on lightly. I don't want to discourage anyone, but it has been a tough time for some of the investors out there. Also going to talk about balancing cash flow and passive income with long-term goals in terms of creating wealth. So I thought before we dive into that, I'll share just a little bit about my journey, just so you guys can understand where I'm coming from. And I'm not just, coming in from a particular place trying to preach or anything, but I'll share about kind of where I started and where I am today. All right, so I've been in Pickering for the last 30 years. I actually moved in with an aunt and uncle when I was going into grade 8. My family separated when I was 4 years old, and my brother passed away a couple of years after that. And I ended up just moving around a lot. So I was with my mom and then my dad and then my mom, my dad, my aunt, my uncle, boyfriend, like moved all around the place. So I think when I started to work, my priority was just to have my own home so that I wasn't going to be a burden on anyone. So I know that sounds a little strange maybe, but for me, that's really why real estate became very important to me at a young age, just because I wanted a place to call my own, that I didn't feel that way. So I went to school for broadcast journalism. I didn't necessarily make it in that industry. I volunteered with Rogers for a couple of years as a videographer, but I was offered a management opportunity with an event planning and staffing agency shortly after graduating. And I basically came on board part-time, then a manager, get led into partnership. And then the founder actually left the company 4 years in for personal reasons, right at the same time actually of the recession. So back in 2008, so perfect time to buy out a company, but I was able to kind of get through that relatively seamlessly. And I built up the company to 10 full-time staff and 2,200 part-time staff across Canada and the United States. We were recognized for our work with 18 awards and several other nominations from 2014 to 2020. So where did investing come in? So I hired my first business coach about 8 years into the company. I realized I've been winging it for 8 years. There's a lot that I don't necessarily know. And I ended up meeting a coach that said, you should really take some of the retained earnings that you have and put it to use for investment, because the average company only keeps 3 to 6 months of operating costs, and I had like a year and a half. So she really tried to push me towards something like that. So I ended up buying a short-term rental in Florida because the dollar was at par back in 2013. And I held on to that for 4 years, and then I didn't know what to do. Kind of felt like I was starting from scratch. So my agency actually started running events with Keyspire. So you can see Scott McGilvery. I'm sure all of you know who he is. So Keyspire is essentially a real estate investing education company. So we were staffing their events in Texas and Florida, just started following along with what they were doing. And I ended up going to their first wealth tour in Toronto with Mike Holmes Jr. and Darren Voros. And it led into a 3-day event, and then it led into their membership. So I went to an investor summit in June of 2018, and I ended up using the money from the sale of my property in Florida to buy 2 pre-construction properties. One that I kept in tenanted, which is pictured here in the bottom corner. The other was a condo in Langley that I intended to sell on assignment. I also invested in a few syndicated mortgages, which is essentially investing in a mortgage with a group of other investors, as well as a land development deal. I also signed up for a writing retreat in San Diego because I always, had been told that I should write a book one day just because of how crazy my upbringing was. So I thought, this is my chance. I'll get the book written. And then shortly after all of that, I got talking to a friend and she suggested that I get into private lending. So that's kind of where that came into the picture. And then as I was trying to build my real estate business, my daughter was born. So that was at the end of 2019. And I had one employee that I had trained and promoted to be my mat leave replacement. She had been with me for 6 years, and she actually ended up resigning when my daughter was just 2 months old. So as you can appreciate, that was very, very stressful, and I just didn't know what to do. So I hired a mergers and acquisitions company to basically value the business and sell it for me. And then we went into lockdown like 2 weeks later. So pretty much the unthinkable that happened. As you guys know, like we went into lockdown, you can't run events in a lockdown. So my company basically dried up overnight. We had about $300,000 or $400,000 in booked business that just immediately got canceled in the span of a week, over $1 million in our pipeline that went up in smoke. So I had to make decisions fairly quickly, and I basically let the majority of my team go. I did hold on to one person just because my daughter was still an infant and I wanted to have support to kind of scale up or down as needed. So we rode that roller coaster for 2 years, but nobody knew how long COVID would last. So I thought, I've been real estate investing already for a few years. I have some passive income from the syndicated mortgages and the private lending. Why not get my real estate license? It's complementary to all of those things. I also got my book finished and I got it published. So that came out in October of 21, and I got my real estate license back in May of 2021 as well. So I kind of continued things along. I just kept my business going throughout the pandemic because it was pretty much impossible to sell. But the main value that we had was that we were really strong with our search engine optimization. So that was really the platform that I used to sell the business. When the last employee that I had quit in January of 2022, I ended up getting a mergers and acquisition, or a mutual release from the mergers and acquisitions company to basically try to sell it myself because I felt like my back was up against the wall. And I just didn't know at that point, did I have it in me to try to rebuild it to what it once was? Like we'd released our office, I had no full-time employees anymore. And I just had to decide if it was something that I wanted to continue with or not. And I basically reached out to a dozen plus agencies in Toronto, and I basically had it sold in 2 weeks. So sold in 2 weeks, closed 2 weeks after on Valentine's Day. I also sold the rental property that I owned in Edmonton shortly after, and I started looking into multifamily properties, including putting in an offer on a package of properties. I think it was around 30 units in Cape Breton, split across 6 different buildings. But it didn't work out. So I actually invested the funds into some other things and just decided to take the year to decide what I wanted to do and just try to figure out the best strategy for me next. Darren, who's pictured on the right here, invited me to join Synergy Mastermind. And essentially that's a smaller group of real estate investors that are looking to level up their investments. And we have weekly calls. So like expert speakers, there's a best in request, we share resources. And there's also 3 trips a year where they bring in different speakers to talk about real estate. And it really kind of opens your mind and expands you to different concepts and what's really possible. And as we wrapped up the last event in Canmore in June of last month, I was also recognized as the member of the year. So even though I feel like I'm on the passive side, I'm maybe not doing some of the things that other people are doing, like building apartments or subdivisions. I've really tried to support people with everything that they're working on. And I think maybe that's kind of part of why I was recognized. And I also joined EXP's Agent Accelerator program with Sukasa. And I've also accepted an opportunity as a business and entrepreneurship coach with the Wealth Club, and that'll be starting in September. So that's kind of where I'm at. In terms of types of real estate investments, I feel like there's things I should highlight, like a disclaimer. So obviously I'm not here to necessarily give advice. Like I think for anyone that is considering investing in real estate, you really need to work on your team. So having a solid lawyer, accountant in your corner, just to make sure that you're getting the appropriate advice before you make any investment. So obviously just take whatever I'm saying with a grain of salt. I have learned a lot, but at the same time, it's no replacement for having a lawyer or accountant review any particular deal before you go ahead. All right, so different types of real estate investments. So I'm going to highlight 5 different types of real estate investments when it comes to being a working or active partner, as well as being more of a passive real estate investor. I think for realtors, we're busy. You may not necessarily have time to put into being more of an active partner. So depending on your access to time or money can really hinge on what strategy would work for you. All right. So before you decide that, you really need to ask yourself a few things. So you want to know, is cash flow really important to you? Is it stability? Is it financial freedom? Are you looking to secure your future? I think the average realtor, and not to put down other brokerages, but with EXP, we have the opportunity to make passive income with our rev share and agent attraction and things like that. But obviously, that's not necessarily common for all brokerages. So I think that's why investing in real estate is so important. And I think for anyone that does have a personal real estate corporation, you can also open up a holding company where you can dividend money into that in order to purchase your investments with. Another strategy that I've been exposed to in the last year to year and a half is infinite banking. And it's something that just sounds crazy, but you essentially overfund a high value cash life insurance policy and you borrow against it so you don't interrupt the compounding of the growth. And you essentially borrow the money to invest with, and then you can put it back later on. And it's kind of an interesting thing. I'm not doing any justice to it, but I would say for anyone that is looking to invest that does have a lump sum of money, this is probably a really good thing to look into beforehand, because there's just so many things that it can offer to you when it comes to tax efficiencies, passing down a portfolio, and just kind of using your money so that it's as efficient as possible in a bunch of different ways. All right, so I guess again, the question is, do you have time or do you have money? So for anyone that doesn't necessarily have a lot of money, some of the things that you can consider are finding a joint venture partner to basically put up the money. So maybe you've got someone in your family or someone in your network that, is doing really well for themselves, but they don't want the hassle or they don't have the know-how to necessarily buy a property. So you could help them find and manage a single family home, a multifamily property, short-term rentals, mid-term rentals. Generally, you'd be responsible for starting a corporation with them, and you would find the property to acquire, run the numbers and underwrite it and manage it. Or in some bigger properties, you might also hire a property manager. You can also consider other things like vendor takeback or seller financing or Airbnb arbitrage. Now, for someone that has money, it's the opposite, but you don't have the time, you just consider the reverse. So you find a working partner that can do the legwork for you and put your money to use. Or there's also a lot of different things like REITs, syndications, mortgages, mutual fund trusts. You've got to keep in mind in those instances that you may be one of many investors, and obviously you don't necessarily have control over what's happening with the working partner. So I think that's where due diligence and diversification is really, really, really important. For anyone that has a lump sum of money and you want to do something like this, I would say, don't put it all into one thing. If you could put it in 4 things or 8 things, and that way they're laddered at different time frames, you're mitigating your risk and things like that. So to dive into that in a little bit more detail. So as I said earlier in the presentation, when people think about real estate investing, more often than not, they think becoming a landlord. So you buy a single family home, you buy a rental property, and then over the long term, you can pay that down. So you're going to look at your estimated cash flow, your principal recapture, your passive appreciation. So just as the time passes and you go through different market cycles, what that value is like in the long run, and active appreciation. So that could be, taking a property and fixing it up so the value on it is more. A lot of the groups that I have been part of in the last few years really don't necessarily encourage buying single family properties, just because, it was kind of explained as having too many leaks. So as we know in Ontario, if you have a non-paying tenant, you're still responsible for your mortgage, your utilities, your taxes. So literally, it's just too many leaks for one tenant. Where if you have a multifamily property, like 6 doors plus, you can commercially finance it. You can go into a longer amortization. You can possibly do a lot less money down. And it's just an easier thing to generally qualify for. And then you also have multiple tenants. So if one is moving out or one doesn't pay rent, you have maybe 5 or 10 others that are supporting all of your expenses. So for that reason, multifamily seems to be more attractive. If it's something you can kind of wrap your head around. In terms of markets, as I shared, I didn't invest here in Ontario outside of my primary residence, specifically because of the LTV rules. I think that it is getting increasingly challenging, and even recently, you guys may have seen in the news that they've changed the rules for, they call them rent evictions. So they're making that even more challenging for people to, take their property and improve the value and then ultimately get higher rent from new tenants. But you can consider things that are out of province. So in the United States, for example, there's something called a 1031 exchange. And what that allows you to do is as you sell your properties, you're not getting hit with capital gains every time you dispose. If you buy a new property within a certain period of time, you can actually defer the taxes as you roll into additional properties. So that's a really big tax advantage. And there's a lot of markets that are just so much less expensive than Ontario. Like it's actually shocking. Like, there's some areas in the Midwest of the United States where you can buy properties for 100 grand. In the East Coast, you can pick up things like you could buy a sixplex in Moncton for $250,000. And I think people are nervous at the concept of, managing a property remotely, but depending on how much money you have access to, there are a lot of other opportunities that are outside of our own backyard. So in terms of short and midterm rentals, so there's a couple different things that you can consider, but I think the main thing right now is looking at the municipal laws, because there are a lot of regulations around the housing crisis and stuff like that. Those regulations have been imposed on short-term rentals where you can't necessarily operate like that. My stepsister actually has a short-term rental in Montreal, and because of those rules changing, she has flipped from a short-term rental to a mid-term rental. And what that means is a stay is 31 days to 6 months at a time. So you might be looking at things like traveling nurses, doctors, construction, basically business professionals that will be in a city for a certain period of time. But you're still getting a premium on the rental. And then you don't necessarily have to worry about things like LTV rules. And you also have a lot less turnover. So you're not worried about cleaning a unit over and over and things like that. If this is something that you want to consider, then obviously I think the location and the amenities are very, very important depending on what you're looking to do, whether that's a vacation rental or it's in the city or something like that. So I think that's far more important than your average rental, but you also need to be mindful of things like vacancies. So when I had my short-term rental in Florida, the people that we bought it from were like, oh, this will be booked all but 8 or 9 weeks of the year. And it was the total opposite. It was booked January to March. I could book that probably 5 years out. And then we were quiet like the whole rest of the year. So like 9 months, we were typically vacant. And sometimes we'd look out and get an extra renter here and there. But for the most part, it was pretty much a break even just when it came to the cost of maintaining the membership fee and the maintenance fees at the condo and all the other expenses. And that doesn't even include like what I was kind of paying off to the business during that time. So there are tools like AirDNA, for example, if you do want to explore what you can look at, like what are desirable short-term rentals in a given area, what kind of market rent you can get for that, and what your expected vacancy would be, just because you do have to accommodate the downs at the same time of having the peak rentals. Another option, if you don't have a down payment, would be considering arbitrage. So for anyone that doesn't know what that is, essentially you're leasing a property and you're subletting it for the purpose of a short-term rental or a mid-term rental. And that way you don't have to put the down payment money out to actually buy it. So obviously you can start cash flowing right away because your only upfront cost would be furnishing the unit. You just have to make sure that it's permitted where you're planning to do that. And you're still responsible for paying the lease if you are having any issues to do with like vacancies. So it doesn't mean there's no risks, but you can obviously get started with a lot less money upfront than you would if you're going and buying a condo or buying a cottage or something like that. So another opportunity would be student rentals. So just like the shorter midterm rentals, you're not necessarily subject to LTV rules because tenants are turning over from year to year. And there is actually a very strong demand for student rentals in various places across Canada. One of them, I know a few investors that have properties in Peterborough that have done quite well, and Cape Breton. So one example for that, I know an investor that has a 6-bedroom property that they bought in Cape Breton for $200,000 and it's cash flowing $6,000 a month. And another investor that I spoke to on my podcast not long ago has an 8-bedroom home and he's renting it for $8,000 a month. So basically renting all these individual rooms, and the property was worth about $500,000. So it doesn't mean that that's without its risks. Obviously, you're dealing with younger adults and they may not necessarily have lived on their own before. So it could come with like a little bit of extra management, but you could definitely get a premium on renting it if it's in the right area and it has the right amenities for a student. So another opportunity for working partners would be BRRRRs or conversions. So for anyone that doesn't know the acronym for a BRRRR, it's you buy, renovate, refinance, and rent or repeat. And, it doesn't mean, again, there's no opportunities for this. I think right now, we've been on a down market. So I think some of the challenges I've seen with some investors is that they're expecting a certain level of appreciation in order to refinance and pull out that equity, which is also refied and taken out tax-free, so you can repurpose it. So you have to, I think, be aware of what's happening in the market and see if this is something that will work for you, because if you don't see the lift, you may need to hold on to that property longer than anticipated, or it may take longer to get that refinance. The other thing to consider is things like the cost of supplies. So one of my real estate coaches actually bought some properties, and she severed 2 properties and built 3 homes. And one of the challenges during that time was with COVID, the cost of lumber went up significantly. There was a lot of delays with labor, and she ended up going $1 million over budget on her project. So that's obviously a very exceptional example, but the point is that sometimes you don't know what's coming in the market, and you have to always plan for those exit strategies or plan for holding on to something for longer, because sometimes you just can't control what's actually happening. That being said, in a perfect world, in a perfect BRRRR, if you were to improve the value of a property, you can take usually the full amount that you invested, so your down payment and your renovation costs, out tax-free, because again, you're not selling, you're just refinancing, and then you can keep on repurposing that into additional properties. So if you buy one, you can do that usually every year or 2 and just kind of continue down that trend. So another opportunity could be land development. And this is something I actually find really interesting, because as realtors, we see a lot of different things that are on the market, and there are a lot of different levels of land development. I'm not going to act like I'm a land development expert, but some of the simple things could be like finding a property that has been rezoned for higher density, and one option could be actually rezoning it, and then you're reselling it. So you're not even doing the land development, you're just flipping the paper. So that could be like taking something to site plan approval. One of the companies in my network that I've invested with bought a student rental in Waterloo for, I think it's around 40 units. It's cash flowing, it's self-sustaining, but they're taking it to site plan approval for 31 stories. And then ideally they're going to flip it to a developer. So the lift on it was very significant. Like, I think they're targeting like a $13 million profit on doing something like that. So they're basically getting it all ready. It'll still take 2 or 3 years in order to do that. That's one big example. I saw a property actually close to home where I am that was for 10 acres for sale for $3 million. And because of the changes to the green belts, there was a short-term moratorium on some building, but TAC put $500 million in resources in around that area. And essentially you'll be able to build in the next 5 to 10 years. So what was $3 million will probably be worth double that 5 years from now. So you can imagine if you pulled $100,000 from 30 investors and bought that and just sat on it, like, the value of it stands to go up significantly. And it was also large enough to build either 70 single family homes or 150 townhomes. So I think just finding those kinds of opportunities as a realtor can be very, very significant. Obviously, you need to just understand what your risks are, and it doesn't mean it comes without any risk. One of the ways that you can do due diligence is to look into the official plan at the municipality and just find out what's actually possible. So sometimes that could be something off market that you see, ideally, and just kind of researching what's possible in different areas, or if there's vacant land that's been sitting for a long time, that could present some opportunities. Just gonna grab some water. All right, so those are all examples of active. So for people that have extra time to dedicate towards things like this, you could have time or money, but ideally you need the time to dedicate towards some of these strategies. And if you don't have time, again, you could be looking at something more passive. So one of the strategies that I really liked in this past year that I was considering was a joint venture. So basically finding someone that has all the time and expertise when you don't. So I think this could be really big when you're looking at like a multifamily property, especially if you're looking to improve the value of it and managing like a demolition or big renovations and stuff like that. I have seen some where joint ventures are split 50-50, but I know of other instances where it could be split higher, like 60-40 or 80-20 in favor of the money partner. So again, you want to make sure that you're partnering with somebody that knows what they're doing and has a track record of doing this repeatedly. But essentially you'll own your own corporation together. And, you just want to make sure you're clear about your exit strategy so that, if 2 years in you decide this isn't working or the working partner isn't working, that's where I think your shareholder and your partnership agreement is extremely important so that you can handle those circumstances and talk about them while the relationship is good, rather than if there's a breakdown or something down the road and then you're left to try to figure out what to do. So another opportunity could be general partner and limited partners. So this could be on a larger acquisition like a multifamily property where you're one of many limited partners. And I do talk about how you can usually do this up to about 50 LPs, as far as I know, before you have to require an exempt market dealer. And basically that would be a licensed business that can sell off-market securities to make sure that you're protected with the Securities Commission. So essentially you'd work with a general partner that is acquiring the property, underwriting it, taking care of all of the work, managing the tenants, and you're one of several investors putting towards that. So say, for example, it was a property worth $5 million. They require $1.5 million for the down payment. So they might take 50,000 from 30 investors, for example, for their down payment and some of the renovations and stuff like that. Again, they're going to be doing all of the work on the property. So it's really important to have solid communication and work with somebody that you trust, and also understand what the exit strategy is like. When you are investing as an equity partner, with common shares, there's no guarantee that you're necessarily going to get dividends from the property. So you do want to fully understand what that plan is like and how it could change with the market shifts and stuff like that. If you are coming in as a preferred shareholder, then there could be some fixed dividends and it could be more of a fixed amount of time. So you also understand what the different types of shares are when it comes to being a limited partner. So other things you may see in the industry would be mutual fund trusts, real estate investment trusts, and syndication. So with mutual fund trusts, it's similar to, an LP in the sense that you're grouping together your money with other investors to buy a portfolio of properties. And one of the big benefits is that you can also use registered funds. So that comes with big tax advantages where you can use your TFSA or an RESP or an RRSP. In some cases, they may offer cash distributions. One of the active partners that I know are offering 17% quarterly in terms of cash distributions. And then you also have deferred interest payments for the end of the term. And I believe the terms are 2 to 3 years. REITs, so usually they're investing in a pool of people to buy income generating real estate, and they're modeled very similar to mutual funds. They do typically offer dividends on a quarterly or monthly basis, and they also would have a deferred interest payment that accumulates over a period of time, which could be like 5 years. And again, they're usually looking at things like multifamily, seniors homes, boutique hotels, and things like that. Syndication. So again, just like in all that, just grouping together with other investors to purchase commercial real estate or buy new property. And depending on the structure, there's a couple things that can impact your eligibility. So if you're an accredited investor, you need to be making at least $200,000 in income for 2 years, or $300,000 with a spouse, and have over $1 million in assets. Another option with an offering memorandum, you need to be an eligible investor. So you need to have at least $75,000 a year in income for 2 years, or $125,000 with a spouse, and over $400,000 in assets. So because these are considered like subject to being risky, they need to make sure that you can withstand a loss if something went wrong. And again, I think that's why it's important to look into your due diligence and your diversification. And you always want to make sure that it's looked over by a lawyer before you make any investments, and also understand the tax implications. So if you are making money on top of what you're making now, like, you want to just consider what the best structure is like for you so that you're not losing a bunch of your hard-earned money on tax. So another option to consider here would be private lending. This is actually something that I've been really focused on for the last 6 years. And for 5.5 years, it went amazing until 6 months ago. And then it feels like, a lot of things have gone pretty crazy. I've done about 70 private lending deals in 6 years. And, I really thought I was very well diversified. And now there's been some challenges that have come up in the last little while for a number of different reasons. And basically what you want to really understand when you're private lending is if you're secured or unsecured. And also when you're doing your due diligence, I would always suggest doing your own independent due diligence. So things like looking into a borrower's background, their credit, their credibility. If there is an asset, do they own it? What the value is, what other liens or mortgages could be on it. So I think that's extremely important because if you are secured, you have priority to basically be paid. And ideally, if your first position in a mortgage, that's probably the very best position to be in. And if you are unsecured, then you don't necessarily have, you're basically not recognized. So the only way to really recognize your interest in the loan is with a general securities agreement where you can register with the Personal Property Securities Act or possibly make an actual claim towards the borrower if there's an event of non-payment. Another option could be a mortgage investment corporation where they essentially invest in pools of mortgages and you could be making a return on that. So oftentimes these are with more risky borrowers, but I have seen still typically between 8 and 12% from mix for a first position, and it could be anywhere from 12 to 16% for second. And those are usually issued monthly or quarterly. So they can be really great for cash flow. So another option here could be pre-construction. I know in Toronto, developers and pre-construction is kind of getting a bad rap right now because of the market going down. So there are some instances where people have bought pre-construction properties and it's not appraising at the value that they need to actually qualify for financing. So I think depending on where you're looking at buying, you just want to understand what kind of bureaucracy is there in an area and like, will it finish on time or are you expecting a 5-year delay? And, what could the market look like in different areas and stuff like that. But some of the benefits is that you can stagger out the down payment when you're investing in something like that. And a lot of them, I think in Toronto especially, you're looking at that lift. So if you buy today, it's ready in 5 years. Well, from the time of purchase to the time of sale, it could have gone up by a couple $100,000 already. And in that case, you could assign it if you don't necessarily intend to close on it. A good thing to keep in mind is that if you are ever looking at pre-construction, even if you sign a sales contract and you change your mind, you have up to 10 days where you can go back and cancel the contract. So you're not necessarily in it forever. So a couple of examples that I wanted to highlight that I thought were really, really unique. So the partners in this project, it's called the Shepherd Project. It's located at Shepherd and Bathurst. What's really unique about it is that it's not just your average pre-construction unit because they're actually selling limited partnership shares. I believe there's 82 in total and half of them are sold already. And you're basically going to come on board as a partner with the developer in the project. So essentially you'd have $150,000 to put down. You'd put another $150,000 towards the actual purchase of a unit. But when it closes, you get your entire investment back. So you're essentially getting a condo, I don't want to say for free because you still pay the balance, but you're getting the full $300,000 back before it closes. So this is over the span of a few years. But the developer basically did a presentation at an event last week, and he described it as democratized real estate development because, as we all know, developers make like crazy amounts of money, and they're basically sharing in the profits with the investors. So it's not like you're just buying a unit waiting for it to close. Like, there's just so much tremendous benefit. So they're expecting the return to basically double your money. And then they call their IRRs 29%, but it's definitely very unique. Like I said, I think they've sold about half. So I think they're looking for maybe 30 or 35 more investors to come on board. But I thought this was pretty awesome. You could assign the unit if you don't necessarily want to close on it. And if you do decide to keep it, they're looking at having a co-management structure where they'll also manage the unit and tenant it for you. Apparently that's pretty popular in the United States, but not something that you see very much here. But it is something for all the LPs that they're looking to offer for those 82 people should they decide to keep the units and tenant them. So another option, talking about real estate investment trusts, I recently connected with someone that has a REIT called Honeytree, and it's specifically focused on boutique hotels. Because of all the short-term rental regulations changing in a lot of places like Montreal and even in Toronto and things like that, they're basically buying up boutique hotels with Airbnb style amenities along with multifamily. So basically they're looking at offering a quarterly distribution. So it's a targeted 16% with 6% distributed quarterly. So 1.5 every 3 months. And then you also have the additional 10% accumulating over the period of time that you own the shares. So it kind of gives an example here of what that could look like. So for every $10,000, for every $100,000 that you put in, you get $1,500 every 3 months. and then the balance of 10,000 a year would accumulate. So at the end of those 5 years, you'd also have 50,000 on top of your principal returned back to you. And again, that's contingent of when you sell your shares. So 5 years is just the example here. So in terms of best practices, so working with a working partner, again, I think having the corporate structure and a partnership agreement is so important. I'm always very, very surprised when I talk to people and they actually partner on a business and they have no agreement in place. And I'm like, what? People obviously don't necessarily expect things to end when they go into business together, but it's always so important to talk about the end at the beginning just to make sure that you're prepared and you protect yourself. It's always good practice to buy investment properties in a corporation, not your personal name. And this really protects yourself from liability and other things that can kind of come about when you own a property and an asset. In terms of raising money, so if you are looking to raise money for projects, it's always safer to bring on equity partners rather than debt because it's not sustainable necessarily with debt if you can't cash out during a certain period of time. A lot of the active investors I've talked to have regretted going with variable rate mortgages because they weren't able to satisfy their commitments when the rates started going up. So even if it's a little more expensive up front, it could be a lot better to go with a fixed rate mortgage just to make sure that you're managing your budget appropriately. As a money partner, I think, again, due diligence, diversification, like there's literally, I can't stress that enough. One tool that I found in the last little while is actually a court case tool. So if you are looking to invest with someone, you can actually look it up to see if they have ever been, if they're in the middle of or have ever been served with any claims or where that looks in terms of settlements and stuff like that. If they have, a repeated history of claims, I think that'll kind of shine a light on if they're credible partners or not. Again, don't enter an agreement without a legal agreement or partnership agreement in place. You always want to understand if your investment is secured or not and what kind of risks there could be, and spreading it out just among different companies so that you are protected when it comes to timelines, exit strategies. I think that's one thing that I found is that a lot of things I've invested in have been delayed excessively. So you can't necessarily count on your money coming back exactly in 12 months or in 2 years. Like I have one investment in a syndicated mortgage that's going on 6 years. So I'm still getting my monthly payments, but the principal has been tied up for a long time because they've been subject to different things happening on the project. So just be mindful that when you are the money partner, I think if you're joint venturing and you're one-to-one, you have a lot more control than if you're like one of 100. So just always keep that in mind with a passive investment. So risk versus reward. I think one of the challenges that I found, there have been some instances in my community where, some people have become insolvent or filed bankruptcy. And I think part of the reason is that they have scaled too quickly. I'm sure everyone's heard, real estate is a get rich slow strategy. And I think part of that is that you need to have appropriate systems in place. You need to build up some equity in your properties so you can cover any challenges that could have come up with like unexpected expenses, market shifts. One of the investors I connected with recently said that he sold a property because he needed cash flow to support his other properties. But if you scale too quickly, you wouldn't necessarily have equity in order to do that. So it's just important to really plan appropriately. And you need to find a way to pivot. Like if there are changes, like short-term rental rules change, CMHC keeps changing the rules, like I think whatever project you're working on, you just have to be very mindful of things that could happen that can affect your plans. So last but not least, again, just keep in mind, like Ontario can be a challenging place to invest in. I know some people that are just not comfortable with the concept of investing out of province or out of country, but there are a lot of other provinces that are landlord friendly, like Alberta and New Brunswick. In New Brunswick, you can usually have a tenant out within a month if there's any issues with non-payment. In Florida, it's usually 75% you can have out in a week, 100% within 30 days. Texas is another location like that. So there are a lot of different places where there are favorable cap rates and landlord laws. So just keep in mind that it's not like this everywhere. It is easier to qualify for a commercial mortgage if you have the down payment because it's the property and the income of the property that's qualifying, not your personal income. So I found that really ironic that, when you compare like a single family home, like you could buy something worth a lot more and it's just easier. It's kind of a weird irony. Again, having your proper documentation, due diligence, diversification, exit strategies, and you always want to think about not so much your return, your ROI, but you want to understand like how is your actual principal going to be returned to you. And last but not least, just finding a community to learn from. There are so many resources now that didn't exist before. So there's a lot of Facebook groups where you can find support. And there are also like paid memberships into investors communities, like Keyspire, Wealth Genius, Synergy, and things like that. So depending on where you want to take it, there are so many more resources where you can learn from what other people are doing and get support and ask questions and things like that. And I always like to say with my podcast, when you invest in yourself, the sky is the limit. So I think, with inflation, investing is just so important. So you can protect yourself in the long term. I've often heard realtors don't retire, they expire. So nobody wants to be killing themselves when they're 75 years old. So I think if you work on building a real estate portfolio, you'll have passive income to fall back on when the time comes that you want to slow down or your priorities shift a little bit. And for anyone that has any questions, I went through this pretty fast because we've got limited time. But if you want to learn more about those opportunities with the Shepherd Project or with Honey Tree, or just ask any questions at all, this is how you can find me.